is Charts of the Week for February 6, 2012 by ProactInvest.net. I'm Richard Wiegand, the founder of ProactInvest.net, and I'm here to welcome you to Charts of the Week, where we discuss some interesting formations and developments in the financial markets. Now, keep in mind that this is not the only thing that we do here at ProactInvest.net. It's not just about market timing and trading in and out of the S&P. This is also a website for conservative, longer-term investors. In fact, the reason I created ProactInvest.net is to help the average investor with their investment strategy. I'm in the process of designing and developing some educational tutorials which will have many lessons of investing. This is not about swing trading. This is about building a solid foundation that generates consistent income, and it's not going to be using leveraged instruments. The bulk of this educational tutorial program, which will be available over the coming weeks, will be all about how to control risk and how to meet your financial goals using some very basic, doable strategies. We're not talking about shooting for the moon here. We're talking about building a solid foundation for your overall investment portfolio. So, having said that, I highly encourage you to sign up here with your name and email address, and so that you can be informed of the latest developments. Also, I'd like to underscore the fact that this website will only be as successful as the subscribers make it, in the sense that if you're going to send me questions or comments or feedback, I certainly welcome them, and I will do my best to address your questions as the developer of this educational program. So keep that in mind. There's a lot going on here. This site is going to be expanding over the next few weeks, so keep your eye out for that. Before we get into the points, summary points of the week for Charts of the Week, there is a disclaimer that I need to discuss every time I talk about financial markets and securities, and that can be found under this menu right here where it says disclaimer. This presentation is not a solicitation to offer or buy securities or participate in any sort of investment program. As the principal of ProactInvest.net, I may have positions in the securities discussed in the presentation. Trading or investing in stocks, bonds, ETFs, options, futures, mutual funds involves risk. You should do your best to understand these risks by researching and comparing them across the major asset classes and security types. If you're not experienced managing investment portfolios, I suggest that you meet with an experienced fund manager with a proven track record. Ask your advisor or counselor or whoever it may be that you're turning to for guidance. How did they do in 2008? 2008 was one of the toughest years to preserve capital, and many people lost their shirts because they were overexposed to stocks. But those who knew how to control and manage the risk, they survived it quite nicely. And so those are the people you want to be talking to. All right, having said that, let's move on to the charts of the week. It's going to be a very quiet week in terms of economic stats and earnings this week. We're essentially done with earnings season, and that was a pretty good season indeed for the most part. So what's going to take center stage this week? Well, it's always tough to know, but I have a feeling that it's going to be international relations and the stories from the Middle East, for example, and the euro currency crisis. In the Middle East, we have the Syrian uprising. The U.S. is closing its embassy there. There's a breakdown of talks, issues with support of the Syrian regime, with Russia, etc., and the ever and ongoing saber-rattling between Iran and Israel. I think these developments are going to be more important than the micro and macro parts of the equation here. Euro currency crisis, dealing with Greece and Portugal, still an issue. We're not completely out of the woods yet. There are certainly some reassuring signs. Here's a weekly chart of the Dow Jones Industrials. We can see that we're at 12,845. And we're within striking distance of Dow 13,000. That's about a 1.23% distance away from where we are right now. We've got some positive momentum here. We've broken out of this resistance area. So it is looking fairly decent here. Don't want to jump for joy yet, but we're on our way. The fear factor regarding Europe and the euro is gradually subsiding. Is this a broken record or what? I personally think that some of this is overdone. For instance, There's clear indications that the central banks of Europe, as well as support from China and the United States, to address the liquidity issue worldwide. And the rights issue from Unicredit Bank went very smoothly. There was a lot of demand for the shares. This is one of the banks that had a lot of exposure to the peripheral European sovereign debt. That seems to be subsiding pretty nicely as well. Let's take a quick look at the euro while we're at it. This is the euro again, dollar euro. We're at 130.73. Just above the 126 level. We're not out of the woods yet. We still have some negative momentum, and this resistance level is posing a challenge currently to the euro, the ceiling. But one thing I do know is that as this euro is going down, the stock market is going up in the face of this. That's a very key point. We have positive momentum here on the S&P and also on the emerging market bond side of things. Here we have an overlay chart of the euro. Dollar euro is the white line, and the emerging market bond iShares ETF is the candlestick chart. And one of the interesting developments that we see here is that right now the EMB, emerging market debt, is actually defying gravity. It is bifurcating like the S&P. As the euro has waned, has declined in value, EMB is actually strengthened. And along with the S&P 500, this is a major bifurcation. In the past, what has traditionally happened is when the euro has depreciated, the emerging market debt fund actually didn't do that well. It kind of like stumbles every time the euro stumbles. What that tells us is that the global financial markets are distinguishing between the sovereign debt issues of the developed world in Western Europe particularly versus the developing world. So it seems as though the developing world's debt is more attractive than the traditional sovereign Europeans, particularly peripheral Europe sovereign debt. So that's a very important development to keep in mind. Strength in the U.S. economy is also bolstering the stock market. Last week we had the ever important labor statistics showing that the unemployment rate dropped to 8.3%. Adding 243,000 jobs last month. This is something to keep an eye on, because if the employment situation continues to improve, the Fed will not engage in QE3 later this year. But one of the things to also pay attention to is, just how accurate are these government statistics about the labor situation in this country. There's still many people who are not included in the surveys, people who have given up looking for jobs, for example. They're still out there. And along those lines, we have Occupy Wall Street and Occupy Washington, D.C., Oakland, New York. The Occupy Wall Street crowd, the protests are still going on, and there's still a degree of domestic unrest. Which is an indication of the weak state of the economy. The Fed is aware of this. They're not going to do anything to tighten the money supply here. In fact, they're doing quite the opposite with coordinated liquidity operations across the major central banks of the world. What do we like in terms of the stock sectors? Well, I did a review of the charts of the major sectors of the market. If I can narrow it down to two ETFs, I would say, mid caps and technology looks attractive, and the defensive areas like utilities are not that attractive. So let's pull up a quick chart or two on these. Okay, here we have the MIDI. I think that this, having broken out of this resistance area here with some positive momentum, I think we could easily go up to 180, 185 area and retest the highs around the spring of 2011. Okay, so I think that this is one of the more attractive charts to take a look at. The monthly chart. Okay, here we have a long-term chart of the cubes, the NDX 100. As we can see, there's some developments here that are interesting from a technical perspective. We've got a long-term double bottom here, positively sloped support trend line that's keeping a bid under this mark, under the technology index. Secondly, we've broken out of this long-term resistance area, the 62 area, and there's no telling where this can stop. I mean, once we go and we stay above this resistance area, there's no telling where this thing can stop. I mean, this can go into the high 60s and low 70s for all we know. But it definitely is an interesting chart formation to keep in mind. In terms of the bonds here, I'm noticing is that treasuries are still out of the picture with the yields that I mentioned last time. In the past two presentations, I mentioned just how unattractive treasuries are at these yields. The real returns are negative. And so we have corporate bonds that are bid. I'm noticing that across the corporate term structure, across most durations, there is definitely a bid for yield. And this is commensurate with the strength in the stock market. Treasuries are out of the picture. Investment grade corporates and even high yield corporates are interesting. And municipals are coming off the boil. I don't think I would buy munis personally at these levels. Commodities are out of favor for now. Really not good. They're really not doing anything. They're rolling over, in fact, what they're doing. If you look at GLD, sandwiched in a range, sort of hit this upper resistance area, and we're kind of like right in here inside this wedge area. Not really that exciting. Silver, also, this is a better chart to see how we're essentially going nowhere. Silver. Let's take a look at oil. Sideways picture again. Still the continuation of status quo. Okay, that's pretty much it for this week. I'd just like to close it with on two subscriber questions that I got, and I will be discussing the answers to these questions in a separate video because I don't want to make this video too long here for Charts of the Week. But the questions asked were these. Should convertible bonds be a part of my overall asset allocation? Convertible bonds are an interesting concept. They're hybrid securities because they're really bonds that have an equity component attached to them. And the question is, isn't that a great way to hedge your risk? Because you don't want to be totally exposed to equities and you don't want to be totally exposed to bonds. You want to be somewhere in between. And so converts would seem to be a simple solution to that whole asset allocation question. And I have an answer to this question, but in return, if you want to get that hold of that video, you got to sign up here. And give me your name and email address, and I will give you the scoop on convertible bonds. The final question that I have here also will be discussed in a separate video is which equity style box has the highest reward to risk ratio. Reward to risk is a very important concept for investors. Okay, if you've ever visited Morningstar.com, which I encourage you to do, you notice that here they have a market barometer of the ever famous Morningstar style box. And what this style box is essentially 9 squares that are showing value-based mutual funds versus growth mutual funds on this axis and large cap, small cap. So if you wanted, for instance, a large cap value fund, you would try to find one inside of this particular equity style box. So you could actually screen for mutual funds and ETFs that fit a particular square. So right in smack in the middle here would be mid-cap blend, which is a blend of value and growth equity stock picking strategies. Small caps are on this at the bottom here, and we have small cap value, blend, and small cap growth. So the most aggressive square would be this one right here, small cap growth, offering you tremendous upside potential in good times, but tremendous risk in down markets. So this would be the most volatile of the 9 squares, and the least volatile will probably be large cap value. If you had to choose one of these style boxes for your equity allocation in your overall mix, your asset allocation, which one should you choose? That's a great question, and I do have an answer for that based on historical data that goes back to 1926. I'll give you the answer to that, but once again, you got to sign up here to be on the email list, and I'll get it out to you. Okay, so having said that, thank you so much for tuning in. Really appreciate your interest, and once again, send me your questions, comments, feedback. I'd love to hear from you. Have a great week.